Hello everyone, welcome back. I am Fiki and today I'll be showing you how to use some basic day trading concepts beginners for beginners. So it will be quick and it will be simple. Okay, so let's just start. So let's start from the definition. What is day trading? So day trading means it is just simply selling and buying financial instruments and profiting from the difference. Okay, profiting from the difference. Let's just say, as you can see here, I am looking at Aussie on the Tradingview.com platform. So Tradingview.com is a charting platform which shows you where the market is going. Okay, what the market is doing. So this is where you will spend most of your time and make your trading decisions. Okay. So as you can see, this is Aussie shape, which means short form for Australian dollar or versus Swiss franc. Okay, Australian dollar versus Swiss franc. So as you can see here, let me just zoom in. If I wanted to buy, let's just say the market was right here when I wanted to buy. Okay, I wanted to buy here, the market was here. If I wanted to buy, I'll just click buy, and if the market ends up going up, if the market goes up, I will be making profit. Okay, I will be profiting. But if the market comes down and melts downside and goes down, then I will be losing money. Okay, it works for both sides. Okay, the upside and the downside. So every market that is going up is called bullish. Okay, you can't say bullish. Every market which is going down is called bearish, the bearish market. Okay. So if I bought right here, then as you can see, the price just ended up moving up. The price moved up, right? So I have profit from this trade. Okay, it is just simple as that. And I wanted to buy right here when the market was trading right here. Pretend that this all price action, this all price movement is not here. Okay, pretend that this is not here, and I wanted to buy this market right here, and I bought it. I bought this market, and look what it ended up. What it did. It did what? It moved downside, to the downside, which means I lost money because I betted it would go up, but what it did is it went down. Okay, so I lost money. So it is simple as that. It's simple as that. So now, as you can see here, the market is right here, right? The market is right here. Obviously, today is Saturday, so there is no trade. This is a forex, So only cryptos are trading on the Monday, on the weekends, on Saturday and Sunday. Okay, only cryptos are trading. If we search BTC, USD, USD will be trading. It will be moving. As you can see here, it is moving, right? So it is now at 42,588. Just wait a second and it will start moving. As you can see, the time is counting, which means we are trading. We are trading. So let's just get back to our Aussie shape. So Aussie shape to our previous currency. So day trading is simply what is it? It is buying low and selling highs. Okay, buying this low right here when the market is right here, and selling when the market is at its peak, at its maximum, right? Selling here and profiting from the difference. Okay, If the market ends up going in your direction, you will be making money. That's it. That is day trading. So day trading is trading within a day, within the day. Exactly. Okay, within 24 hours. If you trade within 24 hours, if you get in the market and get out within 24 hours, it's called day trade. You are not holding your position over the weekends, over a month, over a year. You are getting in and getting out of the market within 1 day. Within 1 day. This is what day trading is. Okay? So what are the benefits? The benefits of day trading? What are the benefits? The benefits are you will be profiting from short-term price fluctuations. Okay? From short-term price fluctuations, you will be profiting. Okay? If you know your strategy, if you use the sound risk management, if you use your money wisely, you will be profiting from those price movements within the day, within that day. Okay. And trust me, there is a lot of money to be made in this forex market. Over $6.2 trillion is traded on the forex market every single day. Every single day, $6.2 trillion is being exchanged on the forex market, which makes the forex market the biggest among the commodities, among the crypto, among the futures and the others, the indices. Among those markets, the forex is the biggest of all. It is the father of all of them. So you will not run out of money. You will be profiting from this market volatility, because if you enter here buy and if the market doesn't move, then you do not make money, because it is not moving. It is stalling or is standing where you entered, which means there is no money to be made. Okay, it is at zero. It has to move up or it has to move down. So that is called volatility. Volatility means it is the movement of an asset. The asset could be the forex pairs, the pairs like this one, like the position. The asset can be crypto, like the previous, like I showed you previously on the BTC, USD, Bitcoin versus US dollar. Okay, that is an asset. It is called an asset. Okay, so this asset has to move up or down. Okay, if they move up or down and within a specified time period, that is called volatility. Okay, volatility means it is a movement of a particular asset. Okay, we need volatility. Is right here. What you are seeing right here is called a candlestick. A candlestick. Okay, this candlestick. Let me zoom in a little bit. This is called a candlestick. We are at a 2-hour time frame, which means this single candle took 2 hours, 2 complete hours to complete this candle, to make up this candle. Every candle you see here used 2 hours of time, 2 complete hours, okay, 2 hours. So which makes this whole price action right here that you are seeing right here, this whole price action right here is around 1 day of trading. You can count it 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, right? 9, 10. 10 times 2 is 20, then add 2 more, 24. This is the candlestick that is between this box. It has took 1 day, 1 full day to make this. Okay, to make this. So what you are seeing here is a 2-hour time frame, candlestick. Okay, let me just zoom in. So let us see the bullish and the bearish candlestick differences. Their difference. What is their difference? So bullish means we are moving up. I told you before, right? Bullish means we are moving up. So bullish movement can be represented by using a green candle. Mostly traders use a green candle, but others can use white candle, yellow candle, whatever color they want, but mostly we will be using green candle to represent a bullish movement or an up movement, a rally up, a rally to the upside, or an increase in the value of the Australian dollar, right, versus the Swiss franc. So this bullish candle, this green candle that you are seeing right here is a bullish candle, and let me zoom in a little bit so we can see it better. So this thing right here, let me use an arrow. This is this bullish. This one is called the opening. This is where the 2-hour candle opened. Okay. This is where the 2-hour candle opened. Then the closing price is where you just did right, that is above here, right above here, right? Okay. This is the opening price and this is the closing price for a bullish candlestick. But for a bearish candlestick, the reverse is true. Let me just use this one. Let us clone this one. Cloning means it is just duplicating. I think of duplicating. So this is what the closing price. Okay. For the bullish candle, the closing price is located above or on the top of the candlestick. For the bearish candle, the closing price is located below or on the bottom of the candlestick. This is called the closing price for the bearish. This one is the closing price for the bullish candle. Okay, do you understand me? Thank you. Then next, click this one to duplicate on Tradingview Platform. Clone. Then it will be duplicated. So the bearish candle's top body is called what? The opening price. It is called the opening price. I told you it is the reverse of the bullish candle. Okay, the up and the downs are both reversed, right? Okay. So the bearish candle, this one, the top of the bearish candle is called the opening price. This is where this candle opened. It opened right here and traded up. The wick that you are seeing is it traded up, and then it traded what? It traded to the downside, right? So it traded to the downside. It closed where? It closed right above, a little bit above this wick. Okay. Now, if we make our surface clear on the closing and the opening price of the two candles, okay, the bullish and the bearish candles, let me just tell you that this bearish candle, this is called the body of the candle. The body of the candle tells you the opening and the closing prices of that candle. Okay, that candle. This one that you are seeing above the body is called the wick of the candlestick. The wick tells you that how high or how low this candlestick went. Okay, there is a difference between the closing price and how high or how low the candlestick moved. Okay, there is a big difference. Okay, so the wick shows you that the market has went this part, but it closed down. The market has went this part to the downside, but it closed opposite. Right? Okay. So the wicks and the bodies are the two parts of the candlestick. Okay. This is just a candlestick thing. You don't need to know anything about this. So this is it. So let us just dive into the next topic. Okay. The next topic. Course, it is not a complete course. It is for just an idea for the beginners, okay, to get prepared, okay, to know what they are dealing with, right? So to deep dive in this course, I will be uploading videos that you will watch, okay. So make sure to follow me down here, down below, because I hope you get some information, some ideas from my experience. Okay, I have been trading for more than 5 years now, and I have been through a lot, believe me, a lot through those 5 years of trading, right? So let me just show you exactly the platform, this trading view. So first thing you have to do is just type trading view on your search bar, and what you have to do is just click enter. Okay, if you are on the phone, just go to Google Chrome and open Google Chrome, search tradingview.com. Okay, then you will enter here. You will be asked to enter your email. Just enter your email and you will be here. Okay, so the first thing that you will notice is, let me just go over here. This is called a watch list. Okay, so a watch list, what it does is it collects what the currency pair or the asset that you want to trade, that you mostly trade. Okay, I mostly trade this currency pair. Okay, I mostly trade this currency pair. That is why I am putting them here, so I can easily access them here, right? So I put them here. So most of these are called forex pairs. They are forex pairs. Some of them are crypto, as you can see, BTC, USD right here. Some of them are commodities like gold, silver, copper, oil. These are called commodities, which means they are tangible. They are tangible. They are not illusioned, or they are not virtual like money or a cryptocurrency. They are not virtual. They are tangible commodities or goods and products that are traded on the online market. Okay, oil, gold, silver, copper, corn, soybean, and the list goes on. But mostly traded ones are gold. I only trade silver, gold, oil, and only syrups from the commodities. Okay, most of the people, most of the traders trade gold, but I do trade silver, and I do trade gold, and I do trade oil. So these are commodities. On the cryptocurrency side, I trade BTC USD, Ethereum USD, Litecoin USD, LTC, Solana USD, and most of them, Mana, AVAX. There are a lot of cryptocurrencies that you can trade. Okay, so to put them on this favorites list, all you have to do is search here, or just click this one, add this plus button, and search whatever currency pair or stock or current cryptocurrency you want. If I want to add LTC USD into my watch list, I will just click this one. Okay, in this case I am on a basic plan, so I can't add more than 30, so I only can add only 30 pairs. Okay, that's what it's showing you, this one. Okay, I am on a basic plan, I am not paying anything, it is free, so I am using free. So these are the currency pairs. The other thing that I want to talk is the index. The 500 American companies are represented by the SPX 500. Okay, S&P and 500. S&P 500, which means it measures the movements of the stock. All the American stocks are measured by this S&P 500. Okay, it is also an index. I also trade it. So this is US 30 that you are seeing right here. It is US 30, which means it is a Wall Street. It measures Wall Street. Okay, you can trade. Google Wall Street on your favorite Google. On your favorite browser. Just search Wall Street or search US 30, and you will get some information. Okay, US 30. There we go. Forex on MT5 companies, people value index, calculator. Okay, everything. This is everything. Just search and learn more. Okay, it is just a beginner's glimpse. I'm giving you a glimpse of what is going on. Okay, So this US 30 which represents the Wall Street, the index Wall Street. So as you can see, it is now on the 37,700 right? So these are called indexes. US 30, Nasdaq 100, S&P 500, Japan 225, Euro stocks, and dollar index. All are indexes which represent, which measures what? Which measures the relative movements, the relative movements of a particular company or the collective of companies or the countries development. It is just an index. Okay, it's just an index. So you can trade it like a forex. You can trade it like a forex. If I assume that it will go down, then I will intercept. Okay, I will intercept. So selling is going short, or assuming that this thing or this US 30 will go down from where I entered. That is called selling. So that's called selling. If I assume it will go up, then that is called buying or going long. It is called long. Okay, so that's all I want to tell you. So these are the time frames, which means the time frames are how much of the time frames do you want to see. Okay, how much trading time do you want to see? I want to see a 2 hour of trading, a 2 hour time frame of trading. So I am in the 2 hour time frame trading because I am a day trader. I don't need to see more than the daily, okay, the daily time frame because I am a day trader. But to base my analysis, to make my analysis, there are a lot of strategies that you need to use, like the supply and demand zones, moving averages, using indicators, using trend following strategies, smart money concept. There are a lot of strategies, numerous strategies that you can use. So those strategies are better yield. They better help you. They help you better if they are based on the higher time frames. So which are the higher time frames? The higher time frames are represented by the 2 hour, the 4 hour, the daily, the weekly, and the monthly. These are the higher time frames. If I want to see the US on the weekly basis, I will just click on the weekly, right? Okay, and it will just show me the weekly basis. Okay, the weekly trading, which means this candlestick took 1 week, one whole week to make this candle, right? To make this candle. The previous chart I showed you used only 2 hours, used only 2 hours to complete one candlestick, right? This one took one whole week to complete this candle because I am in the weekly time, right? Okay, so let's just get back to the 2 hour time frame. The things that you are seeing down here is called an indicator. It is an indicator. It is called an RSI or relative strength index. Indicators show you what the market is doing relative to the previous activity. Relative to the previous activity. It can be the peak movement, it can be the speed, it can be the volatility. Okay, it calculates the previous historical data with the one which is the recent one, and it tries to predict. Most of them try to predict the movements, the next movement, but all indicators are what? Lagging. They are lagging, which means they do not predict the next movement fast. They are not fast. They are very slow, very slow. They tell you to enter a buy after the market has moved a lot. Then they tell you to enter a sell after the market has moved a lot. So we don't have anything on our hands. Okay? So indicators are only used for confirmation. Okay? They are used in combination with the other strategies that you use, with the other analysis that you use. Okay? That's the other analysis. Like 2 and 3 analysis added up with this indicator, they can be very, very helpful in trading. So this is an indicator. To place an indicator, just click here, indicators, and search everything. Just search anything you want, like moving average, also moving average, right here, moving average, convergence, divergence. Just click it, whatever you want, and as you can see, it will place it down here. Okay, down here. This is a MACD, which means it tells you to sell or it tells you to buy based on the RSI or based on the overbought or the oversold positions. Okay. Overbought means the market cannot go above this price, so it starts to go down. That is overbought. The oversold means the market is very, very, very oversold. Now it's time to buy. Okay, the market now changes direction to the upside. They are not mostly correct, but they can be used as again as another confluence. Just click on the name, position, and then search whatever symbol you want. It can be dollar card, USD card, and just click this one. Okay, just click this one. So the next thing that I wanted to show you is buy orders. I mean, stop loss, limit orders, and take profits. Okay, market orders. So I'll show you this one. So first, in order to show you that, I have to go to the cryptocurrencies, because those are the ones that are trading right now, because they trade on the weekends, right? So let us just zoom in here, and I'll show you how you can get a demo account. Right? Demo account or paper trading is what is paper trading? It is just using virtual money. You use virtual money, which is not real. It is not a real money. So you use real money, that fake money, to trade, to exercise your strategies, to test your strategies, to backtest. So by the way, backtesting means it is just testing your strategy on the previous historical data. Not the now, not what is going on now, but on the previous historical data. You can use what is going on now to test your strategy, but mostly most traders use the previous data, like this one. They scroll to the left and see what is going on. As you can see here, this supply zone or this box that I drew has made the price go down, right? So you can see the price is going down because this box is right here. Okay, this box has some significance because on the other times when it nears that box, I will be selling. I will be starting to sell, considering the other confluences, right? So as you can see right here, when the price nears this box, this triangle that you are seeing, this rectangle, the price just melts. Again, it melts. Again, it goes down. Then finally, it broke up, right? So this is called backtesting. Which means going back further, 1 year, 2 years, 3 years, 10 years, decades, and see how the price did against your strategy. If you will see if your strategy really works for me by using backtesting. Okay. So let me open on this Tradingview platform. You can get a free demo account, demo account to trade. It means it is free, and let me just show you right here. So navigate to down the bottom of the Tradingview platform. Let us just make this full screen. Okay. Alright. Okay, sorry, I did it by mistake. Let's just click down here, then click this one, trading plan. Okay, trading plan, right? Trading plan. Then just this one, do this one. So right here you will see paper trading, right? Paper trading means it's simulated, it is fake, it is demo, it is a demonstration money. It is not. You will not get any money if you win. You will not get. You will not get. You will not give any money if you lose. Okay. Just click that one, paper trading, and then just click connect. That's all you have to click connect, and as you can see, they have given me how much money. I don't know. It is $10,000. I think history. Let's just see it on the history. Yes, account history. Yes. Yeah, they have given me $10,000, which means I can buy, I can sell whatever I do, I can do whatever I want. Okay, so let me just show you here. Okay, so I am thinking that this market will go up because I have drawn a trend line. A trend line means, which means, let me just zoom out. A trend line is a line which shows you that the market is respecting this line. Okay, it is just a line. You just click here line and you just draw like this one. Okay, connecting 3 or more places like this one. Okay, just like this one. If you connect 3 or more wicks, okay, wicks are this wire kind of parts of the to zoom in, just click this plus button. To revert to reset the chart, just click this one, reset. Okay, so reset back. As you can see, I have drawn a trend line, which means, as you can see, the price could not move above this trend line because this trend line is acting as a resistance, acting as a ceiling. Okay, this price cannot go up. Okay, it's called a trend line. So in this case, I mean, just like this one, I have drawn a trend line right here. As you can see here, the price reversed direction. As you can see here, now I am wanting the price. I am assuming the price will go up because now the price is supporting. This trend line is supporting here. The price cannot go down below this line because the trend line is like a supporting, it's supporting the price, and it just launches it to the upward. Okay, it is not always the case, but sometimes, but most of the time it works. So let us just buy. How do we buy? On Tradingview, we just click this one. This is called buy the market. Okay. I want to buy, click this one, buy, and I want to buy Unities 1000. I'm sorry, 1000. This is the smallest unit that you can buy. 1000 is 0.01, which means you will each movement will give you or will take from you a cent, 0.0 $0.0 $0.01 will be added or will be minimized from your account if the market is against, right? So this is the smallest amount, 1000. If I want the medium amount, I will add 10,000. 10,000 means it is the mini lot. It is called mini lot. Okay, it's called mini lot. 10,000. If you want the full margin or if you want the standard lot, you will add 10 and it will be $100,000 worth of BTC. Okay, Bitcoin. This is called one standard lot, and each movement will cost you $1. Okay, each movement will cost you $1 if you enter one. Okay, this is how we do. So let's just enter one. Let's just say buy. I have entered a buy. Now I want the price to go up. If the price goes up, I will be profiting. As you can see here, the number is now I mean the number is now in red, which means I am losing now. I am losing because the market is now going down. If the market goes up, the number will be turning to green because it shows you that you are profiting. Okay, you are profiting. So this is how you do. Just there are couple of things that you need to do. The first one is setting a stop loss. Setting a stop loss. Let's set a stop loss. How do you set a stop loss? Just this one, click on this one, right click on that one, then click on stop loss. Okay, stop loss is what do? They protect you from losing more money if the market goes against you, right? So let us just say the stop loss should be right here on the 42,500. So I will just type 42,500. That's as you can see. I will lose 2 million. What? I don't know how that. I don't know how that is. Yeah, because this is a cryptocurrency. It is not the same as the forex. So that's why it's showing us that we are in the billions of dollars currently. So let's just place it. As you can see, there is a stop loss. What does a stop loss do? If the market goes against it, down, if it moves down, then this stop loss will protect. This stop loss will protect. It will not go below this because this is protected. I can go wherever I want and leave this open, and this thing still protects. The other thing that you need to do is right click on the TP or the take profit and click on the take profit. Okay, where do you want to get out of the trade? If you are in profit, where do you want to get out of the trade? That is the question. So in my case, I want to get out of the trade when the price reaches this low, 43,100, right? Okay, let us just place this one, 43,100. As you can see, then just say place. Okay, as you can see, our trade is now in loss because, as you can see, we have entered up there and now the price ended up retracing back, which means going down. Okay, going down. We wanted the price to go up. Okay, in order to make money, this price has to go up because we betted that it would go up, right? We have placed our stop loss down here, which means if the price comes down here and blows past our stop loss, the stop loss will stop it from further damaging our balance, right? From further damaging our balance. The line that you are seeing up here is called the TP or the take profit, which means if the price ends up being profitable, if the price goes up in our direction, just get us out of the trade when the price reaches this one. Okay, so these two lines represent a stopping of the trade. This one is for a loss, this one is for a win, right? A win. So risk to reward means, which means how much did you risk and how much do you want to win? How much are you willing to lose is a risk. How much are you trying to make? How much are you trying to profit is called the reward. Okay. So most of the time your risk to reward has to be 1 to 2. Okay, which means your risk has to be 1-fold and your reward has to be 2-fold, which means your reward has to be 2 times or double the amount you risk so that you are profitable. Okay, so that you are profitable. Okay, so that is called risk to reward. As in this example, this is 1 to 2 risk to reward, which means let's just measure it. I am risking this much, right? And I want to make this much, right? So this is 1, and let us double this one and put it here. This one is ours, right? We have two lines, right? So this means I am and my reward is 2 times the amount I risked. As you can see, this one is my risk, and this one is my the other reward, okay, the profits that I will get from if this trade plays out in my favor. This is the thing that I want to tell you. So as you can see, it is moving up. Let's just get back to the schedule, because that is where I placed my writings. Okay, placed my writings. So the other thing that I want to tell you is about the strategies. Okay, what kind of strategy do you need? How do you know if the price is going up? How do you know if the price is going down? Okay, so there are a number of strategies that you can use. As you can see here, I am using trendline breakouts. Okay, that is my number one strategy that I use always. I use this one. This is now, how does this work? How does this work? Let me zoom in. You find a price that is consolidating, just like this one. Okay, consolidating means going sideways. Going sideways. Let me use a pen. Okay, price might be going sideways, like this one, for a long period of time, just like this one, right? It is going sideways. Okay, sideways from left to right. These kinds of markets are called consolidating. These markets do not move much to the upside or to the downside. They are moving to the west, okay, to the east. They are moving to the right. Okay, so there are 3 market movements. One is, as I told you, the bullish movement, which means upward movement. The other is the downward movement. Okay, the downward movement, bearish movement. This one is the bearish movement, downward movement. This one is bullish or upward movement, right? Okay, and the other one is sideways movement, which means this one is sideways. So we have 3 market structures. Okay. How do you know if the price is moving up? How do you know if the price is moving down? Okay, so you can use trend lines to determine if the price is going up or if the price is going down. Let's just go here. Is this price going up or down from here to here? This price is going up. Why? Because it is making higher lows. It is making higher lows. Okay. It is making higher lows. What is the higher low? So you can see here. What is the higher low? This one, this part. This one is a higher high. This one is a higher high. This one is a lower. This one is a lower low from here. This one is a lower high, okay, because this one is bigger than this one, right? So this one is bigger than this one. So if you see it from here to here, it is moving down because it is making lower highs, right? This was the highest high, and when you include this one, this is the highest high, right? This is the second high. This is the third highest high, right? So when you connect a trend line, it's like this one. When you connect the trend line, it's like this one. The trend line, what is it pointing to? It is pointing to the downward, right? Because the price is moving downward. Because the price is moving downward in this case, okay? When did the price change direction and moved upward? Right there. It broke the trend line right there, right? Broke it and changed it to the upward. But the bullish movement started here, right? The bullish movement started here. Why? Because it broke this lower high, right? It broke this lower high and made a new higher high. If the price makes a new higher high, it is trying to go up. Okay, it is trying to be bullish. Okay? It's trying to be bullish. Then it came down and found a support here and went up and made what? Another higher high, the highest high of all of them, which makes this price action. This makes price action bullish, not bearish, bullish. Until here it was bearish, but here it's changed to bullish because it made a new high. Okay. The simplest way to identify the trend is just to use trend lines. You just use trend line. In this case, we are bearish. In this case, we are bullish. Okay, the trend line is showing it is pointing sloping upward. This one is sloping downward. But here it broke it and now it's sloping upward. We are bullish, right? So the simplest way is to use trend lines to determine the trend, right? But in this consolidation cases, in this case, I'm sorry, I wanted to full screen to make it full screen. In this case, what you are seeing is that there is no high, there is no lower low, because both highs are the same place at the same place. Both lows are at the same place. When you see these kinds of market, it is called a ranging market. It is called a ranging market or a consolidating market. There are some conspiracies that are talking which says that this is a market being, the order is being accumulated to send it to the higher, or to send it up, or send it down. In this case, they sent it to the downside. As you can see, look how much it moved. It moved like hell. It broke every structure, and it broke this low, which makes this one a bearish. This will make this one bearish. How do you know that? You just connect the highs with the lower highs. Okay? Just connect the highs with the lower highs. As you can see, that is why trend lines are useful. Okay, trend lines are one part of the analysis, one part of trading strategy, So as you can see, if you use support and resistance, you can sell when the price reaches here. Okay, you can sell when the price reaches here, when here, and here, obviously. Then finally the price broke this one. Okay, now from the bearish, now it is turning to bullish now. Okay, because it broke this one, it made a new high, I think, right here. Okay, so one strategy is trend line breakout strategy. This is the trend line breakout strategy. This is a trend line, and in this case there is no trend. The trend is to the south, to the sides. That is trading sideways, so there is no trend. We say there is a trend when the price is moving up either, or it is moving down, which we say that it is trending. As you can see, this is trend. As you can see, this is trend. What about this one? This is not trend. If we go here, this is trend, moving up. What about this one? This is not trend. It is moving sideways. It is accumulating. It is accumulating orders to send it to one side. Okay? To one side. The other strategy is called supply and demand. Okay, supply and demand. Okay. It will take much time, a lot of time to explain this thing, but let me just scratch the surface. Okay. So supply and demand means using boxes, using rectangles to identify possible price reversal points. Okay, you just connect the highs with the highs. Okay, connect the highs and the highs with the highs, connect the lows. Okay, where the price reversal, just identify where the price reversal, just like this one. The price went up here, then came down, and again went up, came down, again went up, which makes this one a possible good supply and demand. Okay, there are two concepts in supply and demand. The first one is supply. Okay, supply means selling. Okay, any box that is connecting higher highs is called a supply zone, which means a selling zone. Supply means selling. Okay, just remember SS. Okay, SS. If you see SS, they are just selling and supply. Selling. They both have the same initials, right? Selling and supply. Right? So selling means the price. When the price reaches this box, it comes down. It is called selling. Now here it comes down, but finally it broke it. Okay, it broke it, and then in final broke it to the downside. Now it is selling. Okay, When it comes here, you see. When it comes here, you see, right? Okay, this is called selling zone. This is where the traders are selling. This is the price point where the traders are selling. In terms of the price levels, it is the 58,000 level, the 58,100, the 58,000 sharp 0000. Okay, level. The other one is the demand zone. So demand zone means it is buying zone. When the price approaches the demand zone, you buy. When it approaches it, you buy. Just like this one. The price came down, then you buy. Came down, then you buy. When it comes down, you buy. Look how it did. It worked like a charm, right? Every time, this was you were right. Using the supply and demand zone, right? This is one strategy. As you can see, when it came down, you buy. When it came down, you buy. When it comes approaching it, you buy. Right? Right? The only way, the only place that it didn't work is right here. Okay? You just extend it to this side. Right here, if you had bought, right here, it would have blown past your stop loss and coming back, eating your money down here. And if you bought again here, eating your money now. And again here, eating your money, falling down, because now the trend is now bearish. This is how supply and demand is done. Okay, you just identify the most significant highs and lows and connect them. Okay, these trend breakouts in supply and demand zones are stronger when you connect 3 or more lines, okay? 3 or more highs and lows. Okay, just like this one, I have connected 1, 2, and 3. This one is strong. Right here, I have connected 1, 2, right here, 3, 4, and 5. Okay, this is very strong. As you can see here, it is very strong. When it is broken, it does what? A buying zone, a demand zone. Okay, when a supply zone is broken to the upside, it turns out to be a support or a demand, a buying zone. When a demand zone is broken, when a buying zone, this one is a buying zone. As you can see here, when a demand zone is broken to the downside, it acts as a selling zone, a supply zone. So they both interchange their places. Okay, when you consider supply and demand trading strategy, you have to know that when the supply zone is broken to the upside, it will act as support, and that supply zone will change to a demand, a buying zone again. If that demand zone is broken to the downside, like this one, just like this one, it turns to what? A selling zone or a supply zone. Okay, if the price brokers past that demand zone, you are looking to see if the price approaches from the bottom, just like this. Okay, after breaking it approached from the bottom, so now you are looking to see, you see. Now it again approached, you see. Now approached, you see. But before this was what? A demand zone, a buying zone. After the price broke it, now it turned what? Turned to a selling zone. Okay. This is how supply and demand zone works. The other thing that I want to tell you is the indicators, using indicator trading strategy. The strategy. We have talked two of them, two strategies, Trendline, breakout, and supply and demand zone trading strategy. The other one is indicator trading strategy. Okay. As you can see here, we have the RSI, or relative strength index, which shows you where the overbought and the oversold positions are, where the price is right now. Okay, as you can see here, the price is now at the middle, which means at the 50%, which means it is at the equilibrium point, and you do not look to sell or to buy because it is at the middle. It has to be at the extremes. Okay, it has to be at the extremes in order to sell or to buy, right? As you can see here, it was at the extremes, right? At the oversold position, it was sold over and over again. That it got tired. It got tired. Now it is turning back to a buying zone. Okay, because as you can see, the RSI is telling us that it is oversold. Now the price is time is now the price starts to go up. As you can see, if you had bought right here, you would have been winning trade. Again, the price came down, belonging past this zones, and now touches the overbought position. So the overbought position is represented by the 30%, right? I mean, the oversold position is found on the bottom, and it is at the 30%, right? If you notice it right there, the 30% right on the left. Okay. The overbought position is just the reverse, as you can see here. So you can see it here. Okay, this is the 70% on the RSI. If you look right here, it is on 70%. Okay, when the price reaches the 70%, it mostly reverses direction and moves back to the 30%. When the price reaches the 30% down here, now it tries to move back to the 70% again, so that it is oscillating between the two indicators. Okay, I mean the two places, the two zones, the overbought and the oversold position. If you had sold right here on the overbought position, this would have been a great, amazing sale. This would have been profitable trade. If you had bought right here on the overbought position, oversold position, I'm sorry, it would have been a great trade. Again, a great trade. Okay, right? So this is one way. This is the RSI trading strategy. The other one is moving average trading strategy. Let's just search right indicators and let's just search SME. SMA means simple moving average. Right? Simple moving average. Moving average, simple. Just click it. Just click it. And let me just make it full screen so that you can have a lot to see. As you can see, this line is a moving average. Let's just change the settings right here, the gear icon. So change the moving average into thicker, so that you can see it clearly. Change the color to red or to yeah, let's create purple or something. Yeah, as you can see, this is a moving average which with a period of 5, right? What's the inputs? With a period of 9. I'm sorry, with a period of 9. Right, a period of 9. But mostly moving averages are periods are like 14 and 21 and 27 and 50, 100, 200. And those are when the moving average period increase. The trade, I mean the moving average changes its length. Okay, it is flexibility. If this is a 14-day moving average. Okay, if the price, the most widely used trading strategy with the moving averages are if the price moves. If the price is above the moving average, like this one, you are looking to buy. You are looking to buy. You will never say if the price is above the moving average, like this one. Like this one is above the moving average. You never say you buy. If you are bought here, it would have been a profitable trade. Buy, 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 buy. Then if the price is below the moving average, you say like this one. If the price is below the moving average, you never buy. You never. Don't ever buy when the price is below the moving average, right? So you only look to sell. Sell, 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 sell. This was a great opportunity. Again, above the moving average, buy, 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 buy. Below the moving average, sell. Above the moving average, buy. Below, sell. Above, buy. Okay, this is how you trade with the moving average. Okay. The other thing is to identify the trend. What is the trend? Is the trend bullish or is the trend bearish? To do that, you enter the range of 200, which means the moving average will be calculating the previous 200 days of movement. Okay, for 200 movement of the currency, this currency that is Aussie share, where analyzing the Australian dollar versus Swiss franc, right? So as you can see, the moving average is supporting the price. As you can see, it is supporting it. Now it is resisting. Now it is supporting. If the price is the same price as the previous 14-day moving average, now the 200-day moving average is a little bit. It gives you a little setups, but it gives you a smaller false signals. No false signals. Okay, I mean there is no a lot of false signals. Only a little. Yeah, there will be only a little possibility. If the price is above the moving average, you only look to buy. Right? Okay, as you can see it. If it is below, you sell. If it is below, you sell. If it is above the moving average, you buy. So this is how we use indicators. There are a lot of indicators. I don't want to get in depth with them. Okay, just use it on your own. There are a lot of indicators in here. You just navigate to technicals and you will see you never run out of indicators. So there are a lot of indicators. So there are momentum indicators, there are trend indicators, there are oscillators, there are a lot of them. YouTube is full of them, so I just check out with them. Most professional traders do not use indicators, they use price action and this leading indicators, leading analysis, leading indicators like this trend line. Trend line is not an indicator actually, but it gives you an idea where the price might go in the future. But these indicators like the RSI tells you the previous days or the previous hours price action, not what is happening right now. So I think I have touched almost all of it. The other thing that I want to talk is just find a reputable brokerage firm. After practicing on these trading plans, on this paper trading, like I showed you, practicing. After you practice, after you feel that, if you feel that you are ready to go live, to trade with your real amount, with your real money, so just research the brokerage. There are a lot of brokerages that brokerage firms that gives you a platform, okay, a platform, okay. That is where you put your money. That is where you withdraw your money. That's where you deposit money. Okay, they are like a house, a bank. Okay, they are like a house or a bank. Okay, the money you made will be there. The money you lost will be taken from there. Okay, so there are a lot of brokers like the Hamco Trades, Black Bull. There are a lot of them, as you can see from here. Let me just show you on the paper trading, the previous one. Okay, what was it? See the brokers. Okay, there are a lot of brokers. See all brokers. As you can see, Capital.com, Easy Markets, Pepperstone, Bank, Infoya, Trini, OKX, Binance, Osmani, Whitebit. So Binance and the other crypto and Bitget, these are for crypto, and this 8cap forex.com or under these are for forex and stock and others. FX, CM, these are all brokers that you can use. Okay, I have traded with them so many times. Okay, and there are Webull. Webulls are for stocks. Okay, if you are interested in stock, the same. It is the same. Okay, you just sign up with Webull. Okay, there are a lot of brokers. You just select one and research their reviews. Okay, if you want forex.com review. Okay, just say review and then just click review. Okay, then you will see how the customers, the previous customers, what they did and what they got, and how their think how are they treated, how are they being treated there. Okay, you'll see that. That's how you get a brokerage firm. The other thing that I want to discuss is as you can see, I have told you the stop losses and There are other things like emotions, discipline, and avoiding impulsive decisions. Like if you entered down here buy, and if it ended up being a sale, then you enter again a sale, and if it ended up a buy, and you enter a buy, and so many times entering a trade, so many times will blow your account. Your account will be at zero in no time. In no time. So you have to be careful. You have to be emotions. I'm sorry. So emotions means do not involve in your emotions. Do not involve in your emotions in the trading decision. So your trading decision has to be based only on objective. Okay, objective, which means using your strategy. Select your strategy. I have talked about strategies like supply and demand, trendline breakouts, indicator based trading. Okay, just select one and go with the one that goes with you. Okay, that is comfortable with you, and do what the strategy tells you to do. Okay, just backtest your strategy and see if it is profitable or not. If it is not, just change it and use your depend on the strategy. Do not depend on your emotions, on your brain. No. Just use your analysis, and if that trade plays out, it plays out. If it doesn't, just use a diary, something like a diary, which means I have entered the trade in this day at 2 p.m. The trade I took was on Aussie share, and um, I entered a long, or I bought at this price, and at around 15 minutes, at about 15 minutes, it ended up retracing back and hitting my stop loss. Okay, just you write that one, and write the next one, write the next one, write the next one on a piece of paper or a piece of book, and this will help you realize that what is a pattern. You will see a pattern, how this thing is treated, or how what is wrong with my strategy, what is wrong with my brain, what is wrong with it, what is going on, where is the mistake, is the mistake in myself, is the mistake with my strategy, or is a mistake with other things. So you will identify the mistake by using diaries. There are other diaries. There are other digital diaries like forex diaries. Just search forex diaries. Okay, just search forex diaries, and you will get an idea how, or you will get a free diary to. There are some platforms that even let you store screenshots, snapshots of how the trade goes. Okay, how the trade goes. There are platforms that tells you, that lets you use their platform to record your emotions, to record your trades, record the time, record the snapshot, and everything is okay, so that you do not make that mistake again and again and again and again, and to minimize the losses that you encounter. All right, so that is it. I think it says like books, online courses, and trading communities. Just don't sign up for online courses. YouTube is enough. YouTube is very enough. There is a lot of millions of videos on this trading, day trading, forex trading, commodity trading, stock trading, crypto trading. Millions, and you never run out of information. You will never. So just use YouTube if you are starting out, if you are a beginner. Just do not sign up for courses. Okay. Use YouTube. Use demo trading, Tradingview. Just use trading like I did right here, and paper trade. And try to maximize your profit. Try to increase your initial deposit. If you had $10,000, try to turn it to 20,000. Try to turn it to 50,000. Okay. then you will see what is going on. Okay? And books and trading communities. The trading community, just YouTube is enough. There are some discords that discord servers that you can that if you want to join. Okay, there are some discord servers. Just search best trading discord. Okay, best trading discords. Okay, just search best trading discords and you will have a lot of them. Okay, Prodigy Trading, Crypto Hub, Trading House, Delta Traders. So you can ask questions, and get answers from them. Okay, and follow some reputable YouTubers. Okay, some reputable YouTubers. There are a lot of fake YouTubers that are out there trying to make money off of you. Okay, so try to be careful of them. They are there to make money, not to help you. Okay, they show you a photoshopped result and you will believe it exactly, because photoshopping in these days is in the next level. In this day of AI, there is AI also. So just do what your gut is telling you. Okay, just follow a couple of profitable traders. There are a lot of them. Just there are a lot of them. Just follow them, and you will be learning from them. Okay, from their mistakes. Okay, so you do not do the mistake again. In order of books, in terms of books, just search best trading books. Okay, I don't really I was reading trading for dummies, and they have really good information in there. Okay, like news trading, that I mean how how forex is trading forex for dummies. Yeah, it is trading forex for dummies. And there are a lot of topics that they have discussed. It's around 388 pages. Okay, now I am on the 290 something page. Yeah, I am already trying to finish it. Okay, yeah, as you can see, there are a lot of trading books. Okay, market wizards, technical analysis of pitbull lessons from reminiscence, intelligent investor, a lot of them that will not run out. Okay. So this is all that I wanted to discuss with you. Thank you very much. I hope you have found some information from this, and I will see you in the next one. Consider subscribing, because I will help you a lot. I will help you a lot. And if you found this video helpful, please smash that like button for the YouTube algorithm, because it will reach more people, okay, like you, more beginners, so they do not struggle much. So I will see you in the next one. Thanks for watching. Bye bye.